So, welcome to the Compassionate Capitalist Show. For those that are watching here on YouTube or other means, hello. And you missed the intro that the podcast gets, but the Compassionate Capitalist Show is all about helping entrepreneurs and investors create the wealth that they want to out of successful entrepreneur endeavors, bringing innovation to market, creating jobs, and creating wealth for all those involved. And we strive to educate our entrepreneurs listeners as well as our investors listeners about the sources of capital, about growth strategies, all the things that are needed in order to get to that ideal spot that they can have an exit and get the return on their investment. And so it's really important. A lot of you that listen to this, watch this show on a regular basis, know that we talk about these two main pools of capital as angel investors and venture capital. Angels being private money from individuals, and venture capital typically pooled funds from wealthy individuals and institutional funds. But there's a third category that is big and dominant, but is often overlooked and misunderstood, and that is the private equity capital. Today, my guest, Domenic Rinaldi of Sun Acquisitions. You can wave to those that are watching right now.
Hey, everybody.
Will join me here to discuss the role of private equity funds as a growth capital, but also as an exit strategy for many closely held private companies, and this whole scope of what entrepreneurs and the growth of private enterprise is. So let me introduce you to Dominic so you can understand why it is so awesome that he is my guest today. So Domenic Rinaldi is the owner and managing partner of Sun Acquisitions. It's a Chicago-based merger and acquisitions firm. He's also a speaker, author, and host of the M&A Unplugged podcast. He was awarded the professional designation of Certified Business Intermediary from the International Business Brokers Association and is considered an expert in the field of business brokerage. He is a seasoned executive. He brings over 30 years of proven experience in merger acquisition, sales, service, marketing, and operations to the business brokerage arena. That experience ranges from his experience as an executive roles in Fortune 500 companies, as well as to the CEO of and executive management of multiple tech startups. Dominic's firm, Sun Acquisitions, specializes in helping the owners of privately held companies with annual revenues between $2 million and $30 million to scale, acquire, and sell businesses. He has been personally involved in over 300 businesses for the sale transactions across a broad range of industries and is considered an expert in his field. So welcome to the Compassionate Capitalist Show, Dominic.
Hey, Karen. Thank you so much for having me here.
Absolutely. So first, let's explain a little bit to our listening audience, what was the catalyst for your move from the operational side of entrepreneurism and small business to the funding side of the table for managing the growth of small business, specifically within private equity space?
Yeah, so I've always had an entrepreneurial streak. Going back to when I was a kid, I was always trying to create opportunities and look at ways to generate, money and solve problems. And so, I went into my corporate career and was reared in a Fortune 500 company and spent 14 years there, went on to run a couple of, as you mentioned, tech companies. But I always had the itch for owning my own business. And around 2004, 2005, I found myself in transition. And I thought, that was the right time for me to maybe, explore owning my own business. And I went out into the marketplace to find something that I could acquire. And in the process of trying to find something, I was working with folks like myself, M&A advisors, who were showing me, their engagements, their client engagements. And I started to just do my homework and get enamored with what these folks were doing and how they were doing it. And the more and more I did my research, the more I thought, this might be a great opportunity for me. It would bring all of my experiences throughout my career to bear. And I thought the opportunity, the timing was right. And luckily, I found a firm in Chicago, an M&A firm, small at the time, that was for sale. Met a couple of folks that were in the business for a long time. We partnered up, and next thing I know, I did my research and I bought this business. And here I am 17 years later,
Ah,
having built this business. We've expanded it dramatically over the years.
yeah, great. Yeah, with like 300. So is it 300 transactions since you acquired the?
So I personally have been involved in over 300. My firm has eclipsed the 400 mark.
Oh, wow.
So as you can imagine, as the managing partner and owner, I get involved in a lot of the transactions. I now, 17 years later, don't do any transactions personally myself. I have a team of folks that really run the transactions. I get involved when they need me to, but 17 years later, I've been able to build a largely self-managing business.
Oh, that's great. Well, that's the ideal. Build the clock. It'll always tell time,
Yep,
right?
exactly right. Exactly.
So, well, I'd like to kick off our conversation by laying out two of the most common reasons that companies sort of get stuck or have a relatively flat growth curve and may seek out private equity capital as an alternative to this more widely known sources of capital of angels and VCs. So, the area that I most typically am involved with are those companies that have raised capital, seed capital from angel investors. They invest in these high growth potential startups. It's typically followed by venture capital to sort of keep that momentum going. And for many different reasons, we will find that second and third round of funding will just never really comes for those companies. They just sort of get stuck growing organically through revenues and not really achieving some of the growth milestones that they set out to do when they first, started raising capital as a startup. And they simply do not have the growth capital to accelerate their growth past their current revenue state. So that's sort of like type A or scenario one. And then there are those family run companies that have operated for many years and they're privately held and they've been providing, they've been profitable and all of that. And then there's a second generation coming in that sees potential to bring innovation to the market or growth through acquisitions, but their capital need is not one that can be satisfied by banks, angels, or VCs. So that's sort of our type B scenario two, whatever. So Dominic, I want you to build upon that for the owners and the executive teams that are listening to us today that find themselves in either one of these situations. And let's start with just sort of describing to them what the types of private equity funds that are out there. And granted, VCs have an industry focus. Do private equity funds also segregate by industry? And, do they make these kinds of growth capitals for infusion of capital for growth purposes and not just
Yeah,
acquisition?
lots to unpack there. I would add a third category of just
Okay.
that there are scenarios where private equity can come in when an owner just wants to exit, right? So it's not just
Right.
about the capital; they want an exit and transition out. And that said, yes, exactly right. Just like VCs, private equity groups have all sorts of mandates, industries, sizes, um, holding periods, all sorts of criteria. It's rare that you see a private equity group that has a very broad approach to the market and they're just looking for opportunities based on size or geography. Usually they have a couple of sectors that they've honed in on where either the principals or the private equity group has executives in residence that have certain experience and they want to deploy those executives into certain sectors. And so very much focused on size, geography, sectors, those sorts of things. And in your first scenario where owners want to raise capital, private equity could be a great way to do that. It's very smart capital. These are folks who see hundreds of deals sometimes a year. They have other operating platform companies. They have a lot of contacts. It's really smart money to bring in. And if there's a good match between the management team and the private equity group, you could have a great marriage because now you're going to have not only all of the capital that potentially the private equity group can bring to bear, but you're going to have all of that expertise and knowledge and network and contacts. But it does come at a price. Most private equity groups, and this is not all, but most in the sector that we're working in, want majority control. They
Right.
want to have a majority position in that investment, and most have a time frame for an exit. They're looking at a 5 to 7 year window where they're going to build that business up, take it to the next level, and then flip that business. And growth can come a lot of different ways. It could come organically because they invest and innovate, or it could come through acquisitions. The private equity group gets behind that company, makes a whole host of acquisitions, and then eventually will look to flip that business somewhere in the future.
Right. So in like the example of scenario 2, that could be one where the founder of the company who might be, looking at, he built the business or she built the business as their retirement plan, right? It's like, that's a lot of times you have small businesses and they're like, okay, I'm going to go and I'm going to sell this. But then they have a generation of family or people that are within the company that they want to give an opportunity for them to continue to grow that business. So it oftentimes seems like it's almost a perfect scenario, a partnership where the owner or the founder can exit out a little bit, maybe stay a year. The private equity funds can come in a majority position. The next gen or whoever were the uh, operators that now have equity position have this minority piece, but then they all partner up and work together for growing it, and where all of the value that maybe it's only 20%, but that 20% ends up representing a lot when it comes to an exit. Do you talk about how you have seen that play out with some of your clients, perhaps?
Yeah, clients could approach that situation a couple of different ways. One, it's the classic example of somebody after spending 15, 20, 30 years in the business, or if it's a multi-generational business, 50, 60, 70 years, wants to take some chips off the table, but they don't want to leave the business completely. And so they will, what we call, recapitalize the business and bring in private equity that come in and take over a majority stake. And the owners or owner and management team will roll over or retain some portion of the equity in the business on a go forward basis. And that brings everybody together. So it does a couple of things for the existing ownership. It allows them to take a bunch of money off the table and take a deep breath. And then it brings in really smart money to take the business to the next level. And 3, 5, 7 years later, have what we call another bite at the apple, because there's going to be a second sale. And if it's been successful, they've taken the business to a whole nother level. And now you're selling a much larger business. So you might have rolled over or retained 20, 30% of the original entity, but that 20 to 30% might be worth the original value that you sold the business for, or maybe even more. So you're getting 2 pretty solid bites at the apple, and a very viable way for an ownership team to remain involved in the business, but also, give themselves some insurance by taking some chips off of the table.
Now, would that work also within the first scenario? So there's multiple investors, not just the equity held by the family or the founder. So like in the scenario that I did in that first one, you had some angel investors. They
Yeah.
did a seed round. Maybe they raised $1 million and got
Yeah.
the company off the ground, but never got that other. And they just, grew along, became that 5 million, 7 million, $10 million company.
Right.
And then in that recapitalization, they take out the angel investors and continue forward. And is that kind of how that
But
plays sometimes?
there is no one size fits all, right? That's probably the most likely scenario, that the early stage investors that are not involved in the operation of the business are taken out at the time of that recapitalization. In some cases, there might be a really good strategic reason for everybody to want those investors to remain involved and have a stake on a go forward basis, and so they might be invited to join in the rollover or the retained equity on a go forward basis.
Yeah. So one of the things you mentioned it earlier when you were talking, and I want to revisit that and kind of in relation to private equity compared to venture capital. So, my experience with private equity is that when they make an investment, it's very clear-eyed in that they have a pathway that they believe is a pathway to an exit, that if they do stuff with specific intent with this company, with other things that they're looking at, whereas I feel like sometimes venture capital is sort of their scenario is just continuing to throw more money at a company, hoping for an IPO or a big exit, or, they always talk about these unicorns and things along those lines. So so when it comes time to, like in that scenario that we described before, where they're investing and then there's another exit, if there's additional capital that needs to be brought in order to actually fuel that growth, or to get to that point, is it still a take on the valuation or inflating of the valuation, or is that kind of considered part of the package deal that the private equity fund, it says, okay, it's going to cost us, let's just use a number, 10 million to buy this particular equity for the recapitalization, but we know we're going to invest another 10 million in order to get it to be this $50 million company that we believe we can sell. And so the whole package is sort of factored in as 20 million, even though the full 20 million was at the table at the time. It's just used later on when they do the recapitalization.
Yeah. So first off, it's not a one size fits all, as you can imagine. There are different types of private equity groups with different objectives and metrics, right? And agreements with their investors, right? Because they have an investor pool and they've given them a prospectus, and there's an expectation as to how the capital is going to be deployed and what's going to happen on a go forward basis. But most private equity that we're working with places a value on the business based on what it's doing today, but they're buying it because they see the potential. Now, the investment on a go forward basis could happen in lots of different ways, right? It could be a reinvestment of the cash flows of the business. It could be that they raise more debt to go out and go after that growth strategy, or it could be that they're throwing in more of their own capital to go after that. And so, certainly, if they're throwing in more of their capital, it's going to increase the equity base and the investment base, right, on the balance sheet. And so they're gonna look to get paid that money out first, right? So there's lots of different strategies that they could deploy to get to their growth. But your point early on is well taken. They're coming in with a real plan, right? I mean, day one, they have a pretty good sense of what they want to do with that business and where they want to take it. Whereas, venture capital money is just that, right? I mean, it's venture money, right? I mean, you don't quite exactly know where that business is going to go. You have some hopes, and you're working off of pro formas. Private equity doesn't have to work off of pro formas, right? They have historical performance. They can see what the business has done. And they've got, they're much more informed about, how that business performs and what it could do.
Yeah, so that leads into a good sort of another way to kind of slice up this marketplace when it comes to private equity funds versus venture type of capital. What is the sort of the minimum revenue or profits for companies that are going to approach private equity funds? Is there a scenario where it's too small or too young, or and versus the other side, like $100 million company could still get private equity funds? I mean, is there a
Yeah.
floor and a ceiling?
So, we've painted a broad brush here, but there are massive private equity groups like KKR
Okay.
that do billions and billions of dollars worth of deals, right? And then there are very low level private equity groups who have raised small funds, 30, 50 million, to go do smaller transactions. So, there's a very broad range of private equity groups. In the market that we service, which is largely the sub 50 million of enterprise value, you're going to find that those private equity groups, are looking to raise, a fund of 100 million, 200 million dollars, and they're going after, platform companies that are generating millions of dollars of EBITDA as a minimum threshold. Sometimes we'll see them, have thresholds as low as $1 million. That's a pretty small private equity group.
Right.
By and large, you're looking at a couple of $1 million up of EBITDA.
EBITDA.
Now,
And just real quick, explain that to our audience
sure.
so that, because you and I know what that means, but
Yeah,
just in case for some reason.
that's earnings before interest, taxes, depreciation, and amortization.
It's the bottom
Uh,
line.
it is essentially the bottom line, yes. And so they're looking at the EBITDA businesses and their thresholds, and they all change, right? I mean, some could have $1 million, 2 million, some have 5, 10, $20 million of EBITDA minimum before they're looking to make an investment. Now, most private equity groups, though, when they look at investments, there are more than two categories, but the major categories are they're either making a platform investment, meaning this is a company that they're gonna treat as a platform and they're gonna grow from. And the growth could be organic, it could be other acquisitions, whatever it is. And then there is the add-on strategy. So once they have a platform, they go out in the marketplace and they help the management team of that company go and acquire whatever it is, competitors, technology, geographic expansion, whatever the strategy is, they'll help them go out and make those acquisitions. And so they could be looking at either. When they do add-ons, we've seen in the last, I'd say 3 to 5 years, private equity come way down market to businesses that are doing, $3, $4, $500,000 of EBITDA, because it makes strategic sense to roll it into and add it into the platform company. So it's important to note, though, that while the private equity group is probably leading the effort, the business is being folded into the platform. So
Yeah.
it's while they may be investing and leading the effort, it's really probably getting folded into the platform. So in that regard, you could say you're doing a deal with private equity, but what you're really doing is a deal with a strategic that happens to be private equity owned and backed, and they're leading the effort for acquisitions.
And so is that what they refer to as a roll up? And then all those companies will be sold as one big company at some point in the future?
No, not necessarily. Having a platform and adding on doesn't mean it's a roll up. A roll up is really where you identify a sector and you plan to go acquire as many businesses as you possibly can in that sector. And you're bringing, whether it's technology or some efficiencies to that business, so that by the time you add up all of these competitors, you've created a much larger business with a much larger EBITDA that's going to get a much larger multiple than any of those businesses could have gotten on their own. In a couple of industries that come to mind that are, it's been going on for a while and it continues to go on, are, things in the medical industry, healthcare, like dental offices,
Mm-hmm.
medical practices, veterinarian. It happened in the pharmaceutical industry. If you remember back in the day, all those independent pharmacies
Sure.
in all these little towns. I mean, you really can't find independent pharmacies anymore. They've all been bought up by the big guys. And so there's a good example of a roll up. Or, there were private equity groups that rolled up independent pharmacies and then packaged them up and sold them to the Walgreens of the
Mm-hmm.
world, or the CVSs. And so that's the definition of a roll up.
Yeah. Okay, good. All right, so it's good time right now to tell everybody how to find you, and that is to go to sunacquisitions.com, and it's just like it sounds, sunacquisitions.com. So that's it. And you have a form on there where people can request an initial free consultation and get some, sort of like a talk with somebody on the staff that can talk to them about what some of their options are and things like
Yes,
that, right?
correct. That's right. Yeah. We've got advisors from all different backgrounds, industries and sectors and experiences. And so you make an inquiry and we'll match you up with the right person and get a free consultation.
Yeah. So, what are some of the best practices for deciding to go after this type of funding? How do they approach what they value? Is it really, I mean, you talked about because they can look back at their financials, but is it the same sort of things as what you do in an acquisition where you look at fixed assets and goodwill and these kind of things that become part of the package? And do you, they always say don't, on VCs, don't just go knock on their door because they're reviewing so many stuff. So, how does an entrepreneur or a founder of a company, a CEO of a company like that navigate that kind of space? And I know you help them with that, but you know how people are. They want to try to go
Yeah.
and try to DIY when they first get going until they realize it's a lot harder than they thought. And then
Yeah.
within that context, is there always required to have a broker in the middle of it because they are selling things like part of like a M&A type of a transaction?
Yeah. Yeah. Great questions. And you hit the nail on the head. You've got to start with the right advisors, and beyond an M&A advisor like myself. You have to remember that private equity is really smart money. These are guys that do deals all day long. They analyze businesses all day long, so they know what they're doing. They're really professional, and if they get a sense that you don't have your house in order, they could bolt pretty quickly. So
Yep.
you want to surround yourself with really good M&A advisors, M&A accountant, M&A attorney, M&A intermediary like myself, and do some homework ahead of time. Um, get your house in order. Are your financials in really good order? Do you have a really good plan, strategic plan for your business? Do you know where someone would take the business? If they were, where would they grow it? So if they came in and knowing that all buyers, not just private equity, but all buyers want to take your business to the next level, what can people do to take it to the next level? And what are the sort of investments that they might have to make to get there? And they're going to ask you why you haven't done it yourself, right? But you need to understand all of these things. Put your systems and your operations in order. Solidify your people. Take care of your key employees. Make sure that if there's a transition that's going to happen somewhere down the road, that they're secured for the transaction on a go-forward basis. So do all the things that you need to do to, that a private equity group is going to ask you in discovery so you can put your best foot forward. And then, there are any number of private equity groups that are going to do transactions in different industries. So going to just one private equity group puts all of the leverage in their hands. So if you're going to pull off a strategy like this, you really want to identify all of the private equity groups. And I'm also going to lump into that family offices. We haven't really
Mhm.
talked about family offices, but private equity and family offices that do transactions in your industry, and see which ones would be a good fit for you to go approach and have a plan to go do that. And so I think put your house in order, identify who they are, and don't just go negotiate with one. You want to negotiate with many. It's the only way to know that you've gotten true market value. It's the same thing that you do when you bring your business to VCs, right? You do a bake off and you figure out who wants to give you the highest valuation, right? No different with private equity.
Yeah. So now within that context, so does the entrepreneur, the company propose the terms, or do the private equity funds propose the terms? How do they get to the table to start that discussion?
So that could happen either way. either you could put a value on your business and terms and bring it to the market and say, look, this is what we believe our business is worth. These are the terms that we're willing to accept. Are you willing to play? Most deals, though, don't go down that way. Most businesses, and especially the ones that we represent, we will take the business out to the market and present the performance of the business, and then we'll have what we call a call date, where we'll invite all interested parties to come in and express their interest
Yeah.
and what relative terms they're willing to offer for that business. And based on, what people offer, we decide which ones we're going to invite into the next stage of the process, where we now would let them start to do some discovery so they can sharpen their pencils and do final bids.
Wow.
Because it makes no sense to go into discovery with folks who are not willing to pay you, a minimum threshold
Yeah,
on a
sure.
purchase price. And it's not just about purchase price, the terms, right, of the overall transaction. And so that's mostly how we would handle, a deal to the private equity or family office marketplace.
Yeah. And then there's probably, once you've got the big rocks figured out, then they maybe, if there's a good match, then they kind of finesse some of the smaller details that might be of personal interest to the founder that's exiting out and
That's right.
stuff like that. That's, are the ones that can put the little bow on
And, and it's those little things that sometimes can make or break a deal, right?
Yeah.
We see deals fall apart for the littlest of things, but they mattered to one side or the other.
Right.
So, I find that people more easily agree on purchase price, but it's all the little terms that trip folks up.
Oh, yeah. Oh, yeah. And now, you were talking about sort of some of these things that they need to know, have kind of gotten to their operational sides, standardizing, having really good, clean financials, having their legal paperwork, their I's dotted, their T's crossed when it comes to their employees, whatever their golden parachutes are, all that kind of stuff, right? So now, are those some of the things that you and Son Acquisition offer with companies, or do they need to come already have that stuff together?
Yeah, no, we hope that owners come to us well in advance of wanting to do this, so we have an opportunity to work with them on this level. Uh, you know, One of the problems with privately held companies is that they rarely prepare for these events. And even when they think they've prepared, inevitably they come to us and they haven't really done all of the things they should have done to be able to maximize their value and
Maximize the value. That's a big
and
one.
and minimize their risks.
Yeah.
And so we just sold a business that provided mobile banking disaster recovery. So you have a branch location that goes down because of a flood or a hurricane, or maybe they just need to take it out of service to refurbish it. This firm brings in mobile units, and it can do everything that you did at the branch level with all of the security that the branch had. We first met the owner of that business 6 years ago. And when we met him 6 years ago, we did what we call a market evaluation for him. We also did an overview on all of the key value drivers of his business. We delivered the report, and two things were clear. One, the value wasn't anywhere near what he needed in order to exit. And two, there were tons of things that he could do to increase the value that were low-hanging fruit. And so we gave him the report. He went off, and every year we touch base, sometimes a couple of times a year, and we check in to see how his plan was coming along. And a couple of times we even re-upped the analysis. And after 6 years, he finally got to the point where he's like, okay, I think we're there. We took him to market, and 7 months later we had it sold, and he sold it for a price that was even over what we had thought the value of the business was going to be. And so, great story. And it's exactly what owners should do. Take the time to prepare. It's usually an owner's largest asset, larger than their homes, larger than what they have in their investment portfolios, yet it doesn't get near the attention that many other investments that owners have.
Yeah. Oh, well, I first became aware of that sort of strategy of an owner being, exiting out with a chunk, or that's an outright, acquisition, but, exiting out, having a 5-year plan to finish and grow the thing. When I was first starting Launch Funding Network, which is now just a brand underneath my company, and we were starting to do the advisory kinds of stuff, and hadn't yet taken over the angel investor group that I ended up running and rebuilding. And this company had come to us, very similar sort of scenario, and he was doing where it was a very customized type of reupholstery and would go into like hotels and reupholster and refinish all of, whatever, and usually historic furniture kind of stuff. And we did the same thing. We were like, well, you got, it's your books, it's your operations. It was like, because if he wasn't there, it didn't make any money. Right. And so, and it was really tough for him to accept that he was going to have to do all of that, that they wouldn't just like do it because, buy it because he, whatever. Like, and so sometimes there's the black and the white, or of what's on the paper. And then there's a mental transition and an emotional transition that owners have to come through, and it's probably bang their head on the wall here or there, waste some money in other ways until they finally see that what you're talking about is the real I mean, that's just really how those kinds of transactions happen, because of the smart money of it, is what you're
Yeah,
talking about,
without a doubt. And here's the unfortunate downside of not doing the prep. There's a date on the calendar in which most businesses are going to transact, whether that's succession to the next generation, whether that's to a third party, a liquidation, whatever it is. And the problem is that date may come at your choosing and one not of your choosing.
Yeah.
And what you don't want to have happen is you had all this time to do preparation, maximize the value of your business, and you were waiting because the date wasn't near, and all of a sudden the date gets thrust upon you. And now you're having to sell an asset at a significantly reduced value on your terms that are probably not favorable at all. I just had a conversation with somebody where this happened to them. They got diagnosed with a rare form of liver disease, and they had built this business, and all of a sudden they had 3 months to sell the business.
Oh,
He
wow.
hadn't done all the things he needed to do to get prepared, and wasn't a good outcome. And that could have been avoided because he had plenty of years to build the value, to build the succession. And even, excuse me, even if that had happened, if he had built the plan, he would have had a way for that business to operate with or without him, so that he could get the business sold in an orderly fashion at maximum value. And that just wasn't the case.
Yeah.
Somebody
Well,
got a real deal.
yeah. Yeah. Those are the turnarounds that they talk about, right? Yeah.
Well, it wasn't even a turnaround. It was a pretty healthy company. It just, without him, it was going to be dicey, and he paid the price for that.
Yeah. Well, there's and so part of, when I wrote my book Inside Secrets to Angel Investing, it was really to help those investors that are not part of traditional angel groups, that were not part of, the tech angel investor community, but were sort of your meat and potatoes, bread and butter kind of investors that understood how to read a term sheet, understood how to read a financial statement, a balance sheet, not a term sheet, all the things that you associate with normal business operations, because they themselves are executives in companies, and they wanted to invest in companies that had track record, or had things like that, as really. And what this leads into, because I have recognized that there's this gap of the angels to the VCs, and then they plateau. and this whole other source of capital that I think is so often underutilized. I go to the Association for Corporate Growth meetings every once in a while, and I'm always amazed at how few entrepreneurs are ever in those meetings or at any of their capital connections events. And it's just an incredible source of potential growth capital to accomplish different things that a founder might want to accomplish. And it was important for me to have you on the show because as I work towards my next book, which is focused on entrepreneurs that are stuck and are trying to scale, and they need to understand this. So sometimes they might be able to use some of the Jobs Act ways of raising capital and raise some of the money they might need if they're in a thing where all the dollar they're growing organically because of revenue. They could raise an interim stage of capital to get to the point to pay for the services, to do the things that they need to do with their own specific plan that says, I want to be at a point that I can go and attract private equity infusion of growth capital 2 years from now, 3 years from now. What do I got to do to go do that? And that's, feeding in and, for me, helping those entrepreneurs get to that point so they can, truly be ready for your types of services to be able to get to your network of private equity funds.
Yeah. And, as an asset class, pre-pandemic, private equity had raised $1.5 billion to go make acquisitions. $1.5 billion. It's an incredible amount of money. I'm sorry, $1.5 trillion. What am I saying?
Yeah.
and $1.5 trillion. So you think about, I mean, all the money sitting out there on the sidelines, right, to be deployed. Incredible amount of money sitting out there.
Yeah, absolutely. So as we get ready to wrap up here, I want to give you an opportunity to plug your M&A Unplugged podcast and tell people how to find you and kind of what your topic is. And I think we're working on a date that I can be a guest on your show as well. So tell folks about that, and then we'll, issue some final thoughts and comments.
Yeah. So, M&A Unplugged is born out of my years of experience and seeing that owners and even acquirers don't do the work they need to do ahead of time. They fail to prepare. And so we launched the M&A Unplugged podcast 18 months ago with the sole purpose of educating owners of privately held companies on buying and selling businesses so that they're educated and they know what it goes into actually having to prepare for a transaction. And so it's been tremendous. I've loved every step of the journey. We're fulfilling our mission every day, and it's been a lot of fun. And out of that, we launched a new company that now specializes in helping people do just that, prepare for their transactions.
Oh,
And so, because it is honestly the number one pitfall that people make, they fail to really take a step back and think about what it takes to actually buy or sell a business and the time. I mean,
right.
it could take years in some. I gave you an example of 6 years. It could take a long time to get prepared to do this. Not as much to buy, but certainly to sell could take some time. And so we're dedicated to helping people, be prepared. And the way to reach me, you've already talked about it, my website or my email, drinaldi, DRINALDI at sunacquisitions.com.
Okay, great. And so do they get to the M&A Unplugged just through your website, or is it on like Apple?
They can get to it on our website, or it's on all the major podcast platforms.
Okay.
M&A Unplugged.
Okay, very good. All right. Anything else you would like to add as we wrap up? Any final thoughts?
The only thing I would say is we see the marketplace being very robust the next couple of years. 2020 was a record year for us.
Really?
There are tons of buyers and lots of money out there. And so it's a really good time to consider a sale or a recapitalization of a business because lots of money and lots of buyers. And really appreciate you having me.
Absolutely. I think this has been a great conversation, and I think our listeners will have found value out of the information that you shared. I'm certain of that. And I want to encourage folks to comment and share this podcast with other people that you think would value from it and are in that mode where they're trying to figure out what are they going to do to sell their company in the coming years. And, here you have an expert in that space that can help along the way. Thank you very much, Dominic. And I want to encourage everybody to go to my website, KarenRands.co, and get hold of the other podcasts. Of course, this podcast is available on all those same platforms, but also, get some information about the book. If you're somebody that wants to diversify your portfolio beyond real estate and the stock market and invest in private companies, I think one of our future conversations is going to be how people decide whether they will acquire a company, if they have enough capital to acquire a company as individuals or start a company, or what do they need to go about doing. And you, as somebody that's looking at, the listeners are looking at getting involved in investing in this asset class, get the book. So with that, I want to say thank you again for being on the show. Really appreciated it. Onwards and upwards.
Thank you, Karen.